Good morning, everybody, and welcome to the third and final episode of Chapter 7. Today, we're going to continue with the discussion of raising financing through debt, borrowing money, and we're going to focus on specifically bonds. So, I have referred to this diagram talking about the market. Let me get me out of the way here. The market for capital. So we have all these folks over here that have money. We're talking about individuals as well as institutions, insurance companies, retirement plans, all kinds of different types of parties that have money looking for a place to invest. And then we have companies like Needy Corporation that are needing money to grow and finance their operations. So they could borrow money at the bank by issuing a promissory note. We talked about that in episode 2. They could go to stockholders and issue stock. And we're going to talk about that in chapter 8. But what they might do is borrow the money, but borrow it directly from these investors. Not from a bank, but directly from all these folks out here that have money. And to do that, they would go through an investment banker. So the investment banker is the financial intermediary that brings these two parties together. That investment banker would first of all act as an advisor. A Needy Corporation would go to them and explain to them what their financial needs are. And the investment banker, who has a lot of experience with companies needing financing, will kind of press them on specifically what are their needs, try to make sure they understand the implications of debt versus equity and what would be the best thing for them to do, and also help them understand how much money they need. Sometimes they may not be asking for enough. So they don't want just enough to get started. They want enough to make sure it's kind of off and running until it has time to survive on its own. So maybe they decide to issue bonds. Now remember, in the last section, when we issued a note to the bank, we mentioned that that's a contract. It's an IOU. It's a contract to pay that promissory note back to the bank for whatever amount that note was. Well, in a bond, think of it as a stack of IOUs, and the face value of each one would be $1,000. So if you wanted to raise $400,000, you would have a stack of 400 $1,000 bonds. If you needed $500,000, you would have a stack of 500 $1,000 bonds. So by having a stack of them, then investors can decide how many they want to purchase. And so one person might purchase $5,000 of bonds. Somebody else might purchase $10,000 of bonds. So nobody takes that huge of a risk. They only invest the amount they choose. But the company ends up getting all of their money. And since the risk is spread out a little more broadly, then perhaps the company can borrow at a lower rate of interest. Because the higher the risk, the higher the expected return, the higher the interest rate that would be applied to it. So let me bring you over here. Let's look at a sample bond. So we've got Needy Corporation, and let's say they want to raise $400,000. So they put together a bond issue that says, I owe you $400,000. We're going to pay that back in 10 years. And in the meantime, we're going to pay 9% interest every December 31. Now this would be called a term bond because the entire amount comes due at the end of the term. So notice that we're not, the face value of $400,000 is going to be paid back entirely at the end of the 10 years. So it's not like your car payment or a house payment where you make a monthly payment that pays principal and interest and so forth. The entire face value is coming due at the end of the term. But in the meantime, we are going to pay interest. And in this case, the interest is 9% every year. Remember, you calculate interest as PRT. P, the principal amount, is $400,000. R, the interest rate, is 9%. And that's an annual rate. And we're talking about a whole year, so the T, time period, would be 12 out of 12, or 1. So in other words, we're talking about $36,000 of interest every year. So at the end of every December, the company, Needy Corporation, will send interest checks out to the various people that have purchased the bonds, and those interest payments will total up to be $36,000 every December. And remember, that has nothing to do with paying back the $400,000. The $400,000 is going to be paid back at the end of the 10 years because this is a term bond, meaning it's paid back at the end of the term. The interest is being paid on each interest date, December 31st. Okay? Now, just as an aside, there are other types of bonds. We call them serial bonds, where the principal is paid back in a series of payments. But that's not what we're talking about. We're talking about a term bond where the entire face value is paid back at the end of the term. Now, when the company goes to the marketplace, they're going to try to sell these bonds, paying 9% interest. They're going to be selling these bonds to the marketplace. So when I say that they are selling the bonds, that just means that they're giving them a piece of paper, this IOU, and the investors are purchasing that bond. But this has nothing to do with the sales account. This is not selling a product. This is a borrowing transaction. So a Needy Corporation, we might say they issued the bonds or they are selling the bonds. But when they issue those bonds and they get money, they're going to debit cash and credit a bond payable. So remember throughout this whole discussion that this is a contract to pay money back in the future. It's a borrowing transaction. And I think sometimes students get a little lost on what it is we're talking about because of the lingo. So even if we say they're selling bonds, we're not talking about the sales account. We're talking about borrowing money. And these folks over here that are purchasing the bonds, what they're doing is loaning the money. They are giving money to Needy Corporation with the expectation that they will be paid back down the road and they'll get interest every December 31st. Okay? Okay. Now, one thing that this contract does not say is how much they will give us today. And we just kind of assume that they're going to give us $400,000 today. Well, that may or may not be the case. Think about it from the investor's perspective. They are purchasing this piece of paper that represents these future cash flows. Okay? So the value today of those future cash flows, that would be the price of the bond. That's how much they're going to give us today. And if 9% rate of interest looks good to them, they would give us $400,000 today. If the 9% doesn't look good, if they would demand more interest, you know what, it's kind of like, well, okay, let me back up a second. This is a contract, and this contract, the contract is written in concrete. So kind of enlarge that so you can see it real good. This contract is written in concrete. So as we go into this, you're going to be tempted to change the contract. You can't do that. When the investors purchase this bonds, they are purchasing this future stream of cash flows. They're buying a contract that will pay them $36,000 a year, every year for 10 years, plus will pay them $400,000 back at the end. And I'm talking about this as though it was one big contract. Remember, it's a stack of little contracts that add up to that. Okay, so how much will they pay today? Well, the thing that drives bond prices are what is the going rate of interest in the marketplace. So, there's all kinds of different contracts out there. If you went to the bank to get a loan on a new car, they would tell you the rate for a new car. If you went to get a loan for a used car, they would give you a different rate, probably a little bit higher, because loaning on a used car has weaker collateral, a little more risk than a brand new car. If you were buying a house and you went to the bank to borrow money on buying that house, they would tell you, okay, today, here's the rate on a new home loan today. If you borrow for 15 years, if you borrow for 30 years, that rate's going to be a little bit higher. Okay. But anyway, there are market rates of interest for different types of contracts. And they vary a little bit, so it does pay to shop around. If you're buying a house, you might want to shop around at different banks. But they're all within a pretty close range. Well, when Needy Corporation goes to the marketplace to issue these bonds, there's going to be a going rate of interest for this type of contract. And if that going rate of interest matches the rate that is in the contract, this is called the stated rate, stated in the contract. If that stated rate looks good to the marketplace, if the market deems that an acceptable rate, then these bonds will issue at face value, $400,000. You might also say they will issue at par. Par means face value. So in example 1, that's what we're doing. We're going to look at this same bond contract from 3 different examples. In the first one, the bonds issue when the market rate of interest is equal to the stated rate of 9%. That means that at the beginning, we're going to get $400,000 for these bonds. And in the future, we're going to pay back $36,000 a year in interest. And then at the end of the 10th year, we still have to pay back the $400,000. Remember, the interest is just the cost of renting somebody else's money. Still got to pay it back. So, when you issue something at par, a lot of times bond prices are stated as a percentage of their face value. So these bonds would be issued at a price of 100% of that face value of $400,000. So we're going to debit cash and credit bonds payable for $400,000. So in the blue, you can see I'm crediting bond payable there. At the end of the first year, we're going to make an interest payment of $36,000. We're going to credit cash for $36,000 and debit interest expense for $36,000. So that debit would go to interest expense. Okay, that's what we're going to do every year for 10 years. Now let me look at a couple of questions with you. Question C. Determine the total amount of interest payments over the life of this bond. In other words, if you added up all of these credits to cash for interest payments, $36,000 a year, every year for 10 years, what would they add up to? And the answer is $360,000. Okay? We can see that picture on the timeline. Okay, the next question sounds a lot like it, but it's a different question. Determine the total amount of interest expense over the life of this bond. Well, what I'm asking there is, if you added up all of these debits to interest expense, $36,000 a year for 10 years, what would that add up to? Well, that also would be $360,000. Okay? Same answer, but a different question. So you will kind of see the distinctions between these two here in just a minute. Okay, you may want to take a pause on the video for just a second and take a breather. That is the simple case. And remember, the reason the bonds issued at par is because the rate that was stated in the contract is equal to the going rate of interest in the marketplace for a contract like that. Okay, in the second part, let's go back to the marketplace for a minute. And in part 2, suppose we go to the marketplace with this bond contract paying 9% interest. And when we go to the marketplace, market conditions are such that the going rate of interest on a contract like ours is more than 9%. Let's say it's 12%. So, in other words, these investors out here, when they're looking around at places to invest, they're going to compare this investment opportunity to that one. And so ours comes along paying 9% interest, and that's one of the investment options they have. But if other opportunities are paying 12%, and our contract comes along paying only 9%, how does that look to the investors from the investor's perspective? Well, not too good. And so they're not going to buy that contract at a value of par. What's going to happen to it? Well, it's kind of like we're trying to sell them a car with a dent in it. The only way you can do that is by lowering the price. So a point to remember is that when market rates go up, bond prices go down. They go in inverse relationship. So here we are. Let me kind of look back at it. We are trying to sell this contract to these investors. Remember, when I say the word sell, what we're doing is we are borrowing money. They are loaning us money. And from their perspective, they want more than 9%. So, but these payments are fixed. Remember, this contract is set in stone. It's set in concrete. But if they give us less than $400,000, then all these payments put together will end up being a greater rate of interest than that 9% if they had given us par. So what we're going to do is we're going to use what's called the time value of money concepts. You've heard it referred to as present value, and we would determine the present value of these future cash flows. Remember, those are fixed. We're going to determine the present value of those future cash flows, and that would be the price of the bond today, the present value of that bond. Now, we're not going to go through the present value calculations. That's outside of the scope of this class, but I've already done it. And so let's say the price is 83. That means 83% of face value. That would be $332,000. So they're going to give us, the investors are going to give us $332,000 today. And we're going to pay back $36,000 a year in interest, plus we're going to pay back that $400,000, the face value of this contract when it matures. Now you may be thinking, are we stupid or what? Why would we agree to pay back $400,000 when they're only giving us $332 here at the beginning? Well, don't you always have to pay back more than you borrow? You do, and we call that interest. So what's happening here is we're just paying more interest than we would have if the only interest involved was at $36,000 a year. So some of that $400,000 we're paying back in 10 years is just additional interest. Since we're selling this for less than par, less than face value, we call this a discount. And that discount, when all is said and done, is just going to be additional interest. Now here's how we would record the initial transaction. They're going to give us $332 at the beginning. We give them a bond that says we will pay them back $400,000 in 10 years. And the difference is called a discount on bonds payable. That debit to that account, the discount goes in the liability section, but it has a debit balance. So, liabilities typically have a credit balance, but this is in the liability section, but it's offsetting that bonds payable. So, if this were a live session, I would say, what type of account do you think that is? And the answer is a contra liability. It's in the liability section of the balance sheet, but it's offsetting that bond payable. So it's got a debit balance. And what we're going to do over the life of this bond is we're going to amortize that discount. Here's the word, amortize. So when you amortize a bond, or when you amortize anything, you make it gradually disappear. And we're going to make that discount gradually disappear over time. We're going to do that in conjunction with each interest payment. So we get to the end of the first year, and the first interest payment comes due on December 31st. Now, how much are we going to pay them in interest? Well, according to the contract, which is in concrete, remember, we're going to pay them $36,000 at the end of each December. So we'll credit cash for $36,000. We're also going to amortize 1/10 of this discount. Remember, this is a 10-year bond, and we're going to amortize that discount, make it gradually disappear over that 10-year period, 1/10 each year. And to make that debit balance disappear, we would have to credit that account. So we're going to credit the discount. And then the debit goes to interest expense. And you'll notice that the interest expense for the period is higher than it was in the first example because it includes a portion of that discount. Remember, in total, that discount represented additional interest that we're paying over time. And so we're going to recognize that gradually over the 10-year period. Okay, we're going to do that, make that entry every year when we make that interest payment. If we did that every year for the 10-year period, got those couple of questions to address again. Well, first of all, what would, if we did this same thing every year for 10 years, what would these interest payments add up to over the 10-year period? In other words, these credits to cash, what would they add up to? Well, that would be $36,000 a year for 10 years. That would be $360,000. How about if we added up the debits to interest expense, $42,800 every year for 10 years? What would they add up to? Well, that would be $428,000. What's the difference between the two, 360 and 428? Well, the difference is that discount. That discount, remember, represented additional interest that's been incurred over the life of this bond. So the total interest expense over the life of the bond is the $360,000 of annual interest payments plus that discount. So a total of $428,000. And by the way, at the end of each year, when this is reported on the balance sheet, the liability on the balance sheet will be the $400,000 bond payable minus the remaining debit balance in the discount account. So remember, that's a contra liability. Okay, I've got one more example to work through. And this time, suppose we go to the marketplace and interest rates in the market are down. So here we have a contract paying 9%. And we go to the marketplace, and other opportunities where investors could put their money of a similar risk and so forth, other opportunities are only paying, let's say, 6%. Well, how does that 9% look to them now? Well, it looks fantastic, and everybody jumps at the opportunity to invest in it. But we're not crazy. We're not going to let go of that contract paying 9% if they would be happy with 6%. So we don't sell it right away, and basically what happens is they bid that price up. And so the market rate is down, and the bond price goes up. So remember that inverse relationship. As the rates come down, the prices go up. And it kind of reminds me of that song you sing in Vacation Bible School. It says, when the rates come down, bond prices go up. You might use different words, but it's playing off the one about the rains came down and the floods came up. The story of the wise man and the foolish man, where they built their house. Okay, so let's say that I'm going to go to example 3 here. So the market rate of interest is down 6%. The price of the bond would go up, and I've already calculated that present value to be $488,000. That would be 122% of face value. So we would say that the bonds are selling at a price of $122. So here's what's happening. They're going to give us $488,000 at the beginning, and at the end, remember, we're only going to pay back $400,000 because that's in the contract. Now you might be thinking they're stupid. Why would they give us $488 when we're only going to give them $400 at the end? Well, remember, we're giving them $36,000 a year in interest, so they're getting money back. It's just they're going to make less interest. That extra $88,000 offsets the true rate of interest that is being incurred in this transaction. And we'll see that come out in total here in just a minute. So at the beginning, they give us $488, we debit cash. You always credit the bond payable for the face value, the amount that is payable when this thing matures. And in this case, we got more than face value, so we would call that a premium, and that's a credit. And so we would credit both the bond payable and the premium. So the premium is not a contra liability because it doesn't offset it. It adds to. But the premiums and the discount, both of them together, we would call these valuation accounts because they are adjusting the value of that bond payable on the books. Again, over time, we're going to amortize that $88,000 premium. We're going to do it each time we make our interest payment. And being a credit balance, to amortize it, we're going to have to debit it. So you might just stop the video for a second and see if you can complete the rest of this problem before I do. So we're going to, at the end of the first year, we're going to make a $36,000 interest payment because that's in the contract. We're going to debit the premium for $8,800. That would be 1/10. We're amortizing that premium over 10 years. And then to make the entry balance, the debits equal the credits, the debit interest expense is only $27,200. remember the effect of that premium is to offset the true cost of interest. And so our interest expense ends up being less than that annual $36,000 payment. Okay, back to our questions. If we add up the credits to cash, $36,000 a year for 10 years, they would add up to $360,000. If you add up the debits to interest expense, $27,200 every year for 10 years, that would just be $272,000, less than the interest payments. And the difference is, again, that premium, the total interest payments of $360,000 minus the premium of $88,000, that gives us the total interest expense over the life of the bond, $272,000. And by the way, at the end of each year, on the balance sheet, in the liability section, the bond payable will show up with $400,000 its face value, adjusted by either the discount or the premium. When there was a discount, we subtracted that. If there's a premium, a remaining premium, we would add that. And in this case, the entire carrying value, this is called the carrying value of the bond. In other words, the value that it is carried on the books, or you could call it the book value of the bond, is the bond payable plus or minus the remaining discount or premium. Okay, that's how we account for bonds. I think it takes a little bit of time for this to settle in. It would certainly be worth some practice. I would urge you to do the homework problems first, practice that before you go to the quizzes and ultimately our exam. But we're kind of straddling the line here between accounting and finance, because all of this about bond prices, that all has to do with financial markets and understanding the that relationship between market rates of interest and bond prices, that inverse relationship. It's good for that to settle in. Okay, hope you have fun with it, and I'll see you next time.